Hi, my name is Rajiv Rebello. I'm the Principal and Chief Actuary of Cova Insurance Services, and I'm here just to talk to you a little bit about why insurance products are really great financial planning tools for high net worth clients and why advisors just aren't really using them when they should be. So that's the goal of what I want to kind of get across here today. So let's just jump right into it. So before we kind of get into, why these products are so great, we need to talk about the pros and cons of both the insurance products as well as the value of using a financial advisor and some of the downsides, right, of using either a financial advisor or an insurance product. So here's a quick little table just to kind of briefly summarize the pros and cons, the benefits and kind of negatives of using either a financial advisor or insurance products for your financial planning goals. So let's just start here at the top. So the value here of a financial advisor is that they really customize a solution based on your independent needs. And there's so much information out there, right? Not every solution is the best fit for every client. So the goal of the financial advisor is to understand what your individual risk tolerance is and then craft a solution based around your personality, needs, goals, etc. So the solution, your financial planning or retirement solution might be very different from somebody else's because your goals and personality and risk tolerances, to be frankly honest, are just different. So that's, one of the key values of the financial advisor is that they understand, and again, this is a good financial advisor. We'll talk about a little bit later about bad financial advisors, but a good financial advisor understands all the technical terms and tools available and then meets with you, understands your personality, your needs, your goals, and crafts a solution specific for you. So that's the value of a financial advisor. So they're optimizing, also your investment based on your risk tolerances. So, how much are in stocks, how much are in bonds, when you need the income, all these things are kind of making a custom solution for you. Ideally, this doesn't actually happen in practice, but ideally that's the value of a financial advisor. On top of that, they're doing kind of, very technical financial planning strategies with regards to asset location, which is just tax efficient planning, tax advantage withdrawals. Do I take income from my traditional IRA, from a Roth IRA? How do I think about retirement? Where do I start pulling funds when I need it? How do I start investing? Like, where do I invest the money? Do I invest in a taxable account? Do I invest in kind of retirement accounts? So they're helping you with all of that. So that's the pros, right? So let's talk about the downsides of using a financial advisor. So the first is that it's really easy for them to charge an ongoing fee and not really do anything, right? So you can kind of think of it as a very expensive monthly subscription. We all have that. Maybe it's Netflix or, some other service that, maybe we use it initially, we use it up front, and then we forget about it and we don't use it and they bill us every month. And, at least with a bill, you can actually check and see where the fees are coming out. Wait a minute, I'm not using this. But with a financial advisor, a lot of times you can't even see all the fees that are being deducted. So not only do you forget about it, you're not really getting any value from it, but it's easy to hide the fees and think you're not paying anything. And here's just a couple examples of fees, that you'd be paying here. So you'd be paying, a management fee about 1%. If they're using a custodian, that's probably about 10 basis points. The underlying funds are going to be expensive, usually about 50 basis points. So you're talking about, 1.6%. And that's, again, regardless of how the market does. These fees can be very high, especially. And it's easy to hide, right? So you won't even know. It's kind of cutting out of your account. You won't even realize, that it is because it's not as disclosed as like on a credit card statement when you see the Netflix, being deducted. But, so that's a key downside. And that's kind of, a huge scalable model for the financial advisors. Get you in the door, do some upfront work, but in the back end, just charge your fee and not provide a lot of value. Again, that's, the bad financial advisors, but that's a scalable business. So the other downside is that their solutions that they're providing are not providing any guarantees. There's no, backstops. There's no downside protection. It's you're invested in the market. You're invested in stocks. You're invested in bonds. You take losses, right? Either way. So there's no sort of protection, no pension, no guarantees of any sort. There's no backing, right? There's no regulations that ensuring that these guarantees you're going to be successful in retirement. In fact, financial advisors, they're just doing a model and a projection and say, hey, based on this is your percentage chance of meeting your retirement goals. So on the opposite side are insurance products. So insurance products provide the backstop. So everything that financial advisors cannot provide in terms of providing guarantees, insurance products can provide with additional kind of tax benefits. So guaranteed returns, downside protection, so they can protect against market losses, provide, better conservative assumptions. They can, provide guaranteed lifetime income, that now in the days of, 401k and defined contribution, you're not really having. Insurance products can provide that to you and provide better tax efficient yields as well. So, the better after tax, after risk adjusted returns are going to be higher for if you use an insurance product properly, right? When that's a keyword, properly, than just going through an advisor. So insurance products provide these benefits that financial advisors don't, right? So it might sound great. It's like, I don't need a financial advisor. I'll just go straight to the insurance product, right? That's providing the solution. Well, the downside, like we talked about, is that there's very little explanation of how these insurance products fit into your financial needs, your financial plan, and that's kind of where you use a financial advisor. And you really kind of need one, especially because there's downsides of using insurance products. Just like if there's downsides of using a financial advisor. The downsides here is that these insurance products typically have high commissions and high expenses in the early years. So you really need to keep it for 15 plus years to benefit. And when I say 15 plus years, I'm really talking about life insurance, permanent life insurance products. Annuity products, obviously, you can keep a lot lower, shorter times, 3, 5 years, 10 years, things like that. And the downside, here is that a lot of people cancel the product. So. And this is a double whammy, because if there's high commissions and high expenses in the early years and you cancel it in the early years, you're really getting no value. You're going to lose a lot, if not all of your, the money that you put in. So this is the downside. This is the bad rap that insurance products get, is because most people, are sold a product from a high commission agent. So it's a high commission, high expense product, right? That's why they're selling it. And then the policy owner buys it saying, hey, this is great. Then they forget about it. And then they don't understand the value, mainly because they don't have a financial advisor educating them on why it's valuable to their product, or they just bought a bad product. And then after a couple of years, they're like, why do I have this? They cancel it and they get hit with huge surrender charges. So that's the downside, of using insurance products. So again, you're stuck in this whammy. Do I use a financial advisor? Do I use an insurance product? And ideally, what you should be doing is using a financial advisor that's acting in your best interest to use insurance products that are your in best interest, especially if you're in higher tax brackets. Because the fact of the matter is that insurance products, and we'll talk about more in depth later, provides better solutions, better financial planning, better retirement solutions than advisors can provide. But financial advisors are helping to personalize the solution to your needs and helping you understand the value, and ideally helping you to find good insurance products as opposed to the bad, high commission, high expense products. Unfortunately, the downside with both of these models, right? Ultimately, both the financial advisory industry and the insurance industry, they're business models. They're trying to scale business models, which means providing as much value as they can for as little work as possible, right? That's how you scale a business. So it's easy for the value, right, of both a financial advisor and insurance products to be masked behind high fees and high expenses. And, these are both complicated, products and vehicles and service industries that are not easy to decipher, right? So, if I'm selling orange juice, it's 100% orange juice, and I start watering that down, you're going to tell, wait a minute, the taste is different. Why am I paying this price for, a watered down product? But you can't do the same with financial advisory services or insurance products. The average person can't tell the difference between a high value product and a low value, the 100% pure orange juice versus the 10% freshly squeezed orange juice, right? So that's kind of how to think about the financial advisors versus insurance products. So again, in terms of let's go back onto to the previous point I was kind of talking about with regards to the value proposition of financial advisors and insurance advisors or products, is that financial advisors provide custom solutions, right? Custom, holistic, again, good. I want to emphasize that good, because most advisors aren't providing this, but holistic, personalized, financial planning, retirement solutions based on your needs. Again, understanding your needs, your personality, and crafting a solution based on that. And they're providing a bunch of tax, strategies to minimize the impact of your investing. Or the impact of taxes on your investing, rather. So again, very personalized, holistic. The issue is the financial advisors, they just invest in taxable bonds there's a large fee drag. I'm going to talk about the impact of the fee drag in another video, but it costs you millions. You'll have 50% or more less wealth from using an advisor. They're just putting you in a fund and charging you an ongoing fee. So investing in taxable bonds with a large fee drag and no downside protection, right? That's their retirement solution. They're not providing any guarantees or protections, so that's the downside here. So now a good financial advisor or insurance advisor, even is really not providing financial planning. That's why you need the financial advisor. But what they are providing is a better retirement solution. So, both the financial advisor and insurance products, as we'll see later on, are using bonds, but they're tax-free bonds with a low fee drag, right? Low over the arc of the lifetime, right? Obviously, the upfront fee is going to be high, but over the lifetime, you're better off using a life insurance product for a retirement solution than a financial advisor, because, like I said, that 1% fee drag is significant. On top of that, the insurance products are providing downside protection and reduced volatility are all things you cannot find in traditional markets easy, and definitely not with a financial advisor that's just investing in the market, right? Whether it's stocks or bonds. So good financial advisors have better one-time retirement planning, right? But good insurance advisors have better long-term retirement solutions. So think about it, financial advisor, custom to you needs, one-time upfront, maybe ongoing updates. We'll talk about that in a little bit. But the underlying solution, especially if you're in higher tax brackets, are insurance products, annuities. These products have immense value, especially for retirement planning and for clients in higher tax brackets. So let's just, I wanted to highlight the value proposition of insurance products just from a quick numerical example, because both financial advisors and insurance products use bonds as the underlying, retirement strategy. So if you're a financial advisor, they'll slowly move you over from stocks to bonds as you get older and into retirement. That's because bonds are safer. And same thing with insurance products. They use bonds to provide all these guarantees that so both are using bonds. It's just one is a lot more efficient than the other, because if you invest in bonds with an advisor, you have two things. You're paying high taxes because, bond dividend yields are very highly taxable. That's all ordinary income tax. On top of that, you're paying a large ongoing, advisory fee for the life as long as you live. So, that's the downside. And I just want to do a quick numerical example of, use investing in bonds via an insurance advisor versus an insurance product, right? So in both cases, here's the advisor strategy. Let's just assume the gross expected return is 5% for both, right? That's a gross return. If you invest with an advisor, you're getting 5% on your bonds. Unfortunately, if you're investing with an advisor in bonds, that's all. Most of that's going to be taxable bonds, right? So that's this marginal tax rate. This is the top, federal tax rate, more or less. Or federal and state. Let's say federal and state tax rate. And we'll talk about how in certain states with higher incomes it's actually higher than this. But we're going to assume 40% for federal and state. So of this 5%, if you're using an advisor, you're losing 40% off the top. So I'm down 2, right? So that gives me a net of 3. After taxes, I'm at a net 3. But then I got to pay the advisor his or her ongoing fee, right? So that's minus 1%, right? So now I'm losing that. I'm not paying any insurance expenses, which is good, right? But so on that 3%, I subtract the 1, I'm at 2. So on a 5% gross return, right, I as the client am getting about 2%, which is more or less, keeping up with the cost of inflation, right? But I'm losing 60% of the return, right, to taxes and fees. And people aren't kind of realizing this. If the advisor is just going to put you in bonds, like this is the effect, right? This is the ongoing drag. And we'll talk again in another video about like this is a large fee relative to your after-tax return for something fairly safe, right? So now bonds within an insurance strategy, again, same 5%. You're not paying taxes on the bonds, right? There's no return loss to taxes. So you still gross return is 5%. You're not paying an advisor fee, but you are paying insurance expenses. And let's say those insurance expenses are about 1%. So you're getting about 4%, about 4% after taxes on the bonds strategy. So if you're investing in bonds, you're doubling the returns, right? So high net worth clients are doubling their bond returns by using an insurance product to invest in bonds instead of an advisor. Again, I'll go into this more detail in another video, but just understand like this is the value proposition is that insurance products are providing a vehicle to invest in bonds that are more tax efficient and have less fee drag over the lifetime of your retirement than a traditional financial advisor, right? So on this slide, I just want to quickly go over people get caught up in or don't get caught up, don't realize the impact of their tax rates. So what I did is I just took some of the states with the highest state income tax rates. and kind of showed you what those are. So again, the federal tax rate, it's the highest tax rate is 37%, and then I added the 3.8% net investment income tax, right? So you're at 40.8% or 41%, right, just before state taxes. And when you add state taxes, again, these are the highest state marginal tax rate, 14%. You can see New York, New Jersey is not surprising, but these are all 50% plus, right? So if you're married, and making 400K plus, obviously if you're single, it's roughly half than that. You're losing 40% to 50% in taxes by investing in taxable bonds. That's just the fact of the matter. And that's why if this is your financial advisor strategy is going to put you in bonds as you get closer to retirement, it doesn't make sense. It really just doesn't make mathematical sense. Now, obviously, like we talked about, it's easy for financial advisors to scale a business model that way, but for the client, it doesn't really make sense. On this one, I come back to this idea of like the difficulties that you as the client face when you're trying to decide, should I use a financial advisor or an insurance product? So you're in the middle. Obviously, you don't understand like personal finance, math, retirement accounts, marginal tax rates. All these things are complicated, and most people are busy with their jobs, busy with their lives to really spend years, and it takes years to understand the value of this, to really dive in. It's not something you're going to learn overnight. But the downside is, again, I'm going to describe bad financial advisors and bad insurance advisors. The financial advisor is sitting over here saying, essentially, hey, let me manage your retirement for an ongoing fee that will cost you millions. Again, it really does cost you millions. I'll show you another video. So subscribe to the channel, and you'll get that video when it comes out. But yeah, and this ongoing 1% retirement fee, it's going to kill, both the wealth for you and your beneficiaries, right? So you're trying to decide, well, you need the help, but this doesn't sound attractive at all. On the other side is the insurance advisor, right? So he or she is saying, hey, let me sell you a one-stop retirement product that you will most likely cancel and get hit with huge surrender charges and walk away with very little, if anything, right? So these are your two options. Which are you supposed to choose, right? It's not really, you're stuck between a rock and a hard place, and that's kind of like where the industry is. It benefits and profits from your lack of understanding and inability to distinguish a good financial advisor from a bad one, or a bad insurance advisor from a good one, So that's essentially the predicament you're caught up with, and there's huge conflicts of interest, right? And namely is that the financial advisor doesn't get paid on assets you invest in insurance products, right? On the opposite side, the insurance advisor, if you invest, with a financial advisor, he or she is not getting paid on assets you invest in the market. On top of that, the more expensive the product you buy, the more he gets paid. So his incentive isn't to find you the best product; it's to sell you a product with the highest commission, right? That's just, the interest incentives involved, right? He gets paid more the higher the commission product he sells you, and the higher commission product he sells you also happens to be more expensive, right? So, what are you supposed to do if you're sitting in the middle? What are you supposed to do? And that's the difficulty. There's conflicts of interest here. When ideally, like we talked about, they should be working together. So, and when I say working together, it's you essentially meeting with a financial advisor who understands who you are, specifically your risk tolerances, like what you're comfortable with investing in the market versus insurance products. And based on your needs and desires, he's like saying, okay, well, this amount should be in the market. This should be in insurance products. He's figuring out a solution based on your needs. So it's a holistic plan that incorporates insurance as a key part of the financial plan. So the financial advisor, again, large one-time upfront fee, and then ongoing updates, right? And we'll talk about the value of a financial advisor in the long term, but that's kind of how you should be looking at it. Again, the higher tax brackets you're in, the more beneficial it is to use insurance products, but you need a financial advisor who's explaining it to you and how this fits in to your holistic solution. Unfortunately, one of the things a lot of clients do is they'll say, oh, this sounds good. They'll go and get an estate plan, or they'll go and get, this, I'll pick this stock, I'll pick that stock. And they don't understand how everything kind of fits together. So that's where the financial advisor is, ideally helping you understand, like, how does everything fit together? You can't have 10 different individual pieces that don't actually fit together. It's like a basketball team, right? Like, you can't get 10 or 5 Kobe Bryants on the team. You need a Shaq, you need, other role players, to kind of, augment the team. So that's kind of how, you should think about it with both your parts of your financial plan. They all need to collaborate together as part of a holistic plan. So kind of talking about it, the financial plan is really the engine of your retirement strategy. So again, like a car engine, I'm going to use that. It takes, again, all these different pieces, right? Your Social Security, pensions, home equity, brokerage accounts, retirement accounts. And again, on top of that, your needs, and puts it all together. So before you do that, it's just a bunch of individual pieces, right? They don't really fit together. It's just a mess, right? Like it's a mess. And it's costing you lots, it'll cost you a lot of money in terms of like doing this individually versus optimally using it in a way that meets your best interest. So again, this is just an example of a financial plan before using a good financial advisor, right? So a financial plan before a financial advisor is just a messy collection of parts. However, after a financial advisor, the financial advisor is teaching you how to use all these different pieces collectively as a unit. So taking all these individual units and essentially making it an engine. This is how your car is going to run. Right, these all fit in. They'll all have a place. Your brokerage accounts, retirement, home equity, Social Security, again, insurance products, right? So the financial plan after using a financial advisor is a well-run machine that integrates all parts of your financial and behavioral lives, right? So that's the way to think about the value of a financial advisor. Insurance and annuities are a key tool in this plan. Again, the higher income you're at, or the more you want protections, and it's usually a combination of both, right? You can get better retirement solutions by using insurance products. So that's a key tool that you're using to fix your financial plan, to fix your engine of your financial planning solution. So this solution, insurance and annuities, provide higher bond returns. So you're going to get higher gross returns than investing in with an advisor, and we'll talk about that in another video, between short-term bonds and long-term bonds, because advisors will invest in short-term bonds to avoid interest rate risk, but insurance companies have long liabilities and investment horizons, so they invest in higher yielding long-term bonds. So you're getting higher gross bond returns, you're getting downside protection, guaranteed returns, tax-deferred or tax-free returns, guaranteed lifetime income, right? So these are all benefits that cannot be found elsewhere. The advisor cannot find these products elsewhere outside of insurance products. And so that's a key thing. Insurance and annuities provide benefits that cannot be found elsewhere. So it should be a key part of a financial plan, right? So the other thing I wanted to touch base on here is kind of the helping you understand the value of a financial plan, right? And how much you should be paying for it. So we talked about the value of a financial plan of fixing an engine, right? So that, if you think about it in the context of a car, the engine is the key component. Like that's what drives everything. So there is a tremendous value of providing a financial plan to a client, especially if they're not knowledgeable and so about finance. So the financial advisor is really spending a lot of time taking all this knowledge and breaking it down into simple concepts that the client can understand, right? But unfortunately, advisors don't charge the same for year one, or they do charge the same for both years 1 and 2 going forward. Although years 2 going forward are just updates. They're just updates. So if you think about it, does it really make sense to pay the price of fixing an engine in every single year when you're really just getting oil changes going forward, right? So why are you paying such a huge price? And that's the downside, like we talked about, of the drag of paying a 1% ongoing fee, right? You're paying this ongoing fee, but you're only getting essentially the equivalent of oil change updates. So when I talk about oil change updates, I'm referring to this, like the review of the financial plan, review of investments, safe spending limits. You're adjusting your safe spending limits, review of life insurance and annuity. Like, this is basic stuff. This is basic oil change updates. So if you're paying 1% for just this basic stuff, you're essentially paying 1%, the price of fixing an engine for an oil change. So I say this, to help people understand that this is what most people do. This is the business model, right? Like, they're not really making that money in the first year, but ongoing, they're making a lot of money by essentially providing oil change updates for not providing much value. And make sure that you understand that doesn't mean that 1%, charging an ongoing AUM fee is not worth it. Because if they're providing essentially engine or partnership updates, which is holistic integration of investment, wealth, tax, estate planning needs, they're looking at appreciated gains. You have appreciated gains in their portfolio. How are we looking at that? Donor advised funds, CRATs, tax loss harvesting. Are they doing that on an ongoing basis? In-depth asset location planning, estate planning. What assets go inside my estate and outside the estate? GRATs versus PPLI. How are you advising on, how are they advising on family dynamics within your family, inheritance, who's taking charge of what part of the holistic family well-being and wealth transfer. So this model here, is more is more holistic, and so if they're providing this is a partnership model. This isn't an oil change update, so this deserves more of a 1% type compensation, because it really is a partnership. They're looking over all parts of your financial life, right? So I'll have another video that kind of goes into this, but when I say charging 1%, I'm not saying it's always a bad value, right? Because if they're providing this, it could be great value, right? But if they're charging 1% and providing this, then it's not. And so I think it's understanding what value are you getting for the fee that you're paying, right? So that's the way to think about these things in the context of financial planning, both insurance and a financial advisor. So I'll close again with this: is that every financial plan includes a part for retirement planning and retirement strategy, and all of those strategies involve the use of bonds. And if that's the strategy, you are much better using insurance products for the long-term solution for investing in bonds than you are from using a traditional advisor, and who to charge this 1% ongoing fee, right? You're much better using insurance products and annuities, and for these solutions. So that kind of concludes this presentation. This is essentially what we do: is we educate, both high net worth clients and advisors, family offices. How do we use these insurance products for the best use of clients, right? So for advisors who are truly looking to do the best thing for their clients, for high net worth clients who are trying to understand, how do I learn more? How do I, educate myself more so I can distinguish, right, between a good financial advisor and a bad financial advisor, a good insurance product and a bad insurance product. That's what we do. We work with clients to do that, because it's just a huge missed opportunity in the space. So hopefully you enjoyed this video. Again, I'm going to try to do more videos. Hopefully you'll subscribe to the channel. And we'll continue to do this to develop a rapport with clients and build a brand, and hopefully educate advisors on how to use these products as the industry and kind of goes towards more fee-only products, and educating advisors, and because there's a huge missed opportunity here. So that's what we do. If you'd like to get in touch with us, please reach out. You can visit our website at culvaservices.com or drop me an email. All right, talk to you in the next video.